Hi, this is James Amos Full Capital, and I'm here with Fritz, with Colliers. Fritz, how's it going?
Going great. Thanks for having me, James.
Thanks. So thanks for jumping on. What we wanted to do was just give people a little bit of your background and sort of how you got started in the business and then sort of progressed into your current role and then talk a little bit more about Colliers.
Sure.
Yep.
So I've been Colliers now. Gosh, it's been almost 11 years. Just about 11 years. Started in my kind of the credit Fannie Mae group on the underwriting side. Basically, right after college, I actually put a year of football over in Germany, and then started at what was the Doherty Companies, which is the predecessor to Colliers Mortgage, in the Fannie Credit Group, and then moved over to production in 2014 and 2015. And closed between $3 and $4 billion worth of Fannie Mae loans over the last 10 years. So that's kind of my focus, kind of all over the country. Colliers Mortgage is who I work for, and Colliers is a Fannie Mae DUS lender, as well as a Fannie Mae FHA MAP approved lender. We also have a correspondent relationship with life insurance companies and other capital sources as well. But my focus primarily is on the agency business.
So you grew up in multifamily the same time that I grew up in multifamily, which
Yeah.
so tell people the progression because I remember a little bit about what happened in 2015, 2016, but give people like go back to 2015 and do you remember sort of roughly what were deal sizing like back then, like back in the good
Oh
old days,
gosh.
2015?
I mean, 2015, you were probably full 80% leverage. You were never debt service constrained. It was always usually some sort of LTV constrained. Rates were a little bit lower. I mean, I feel like the 10-year was probably around 2%.
Okay.
And so you had rates in the high threes, low fours. And so cap rates at that point were still, significantly higher than maybe even where they are today. But interest rates were a lot lower. And so you had a nice spread there between what you're borrowing at and what the cap rate was. So it was a great time to buy multifamily. It might have been 2015, might have been like the perfect time to buy multifamily in the last cycle.
Yeah, I like went back and looked at some deals that, people had bought in 2015 and we had, we were short like 200 or 300,000 like our buyer didn't win the deal and then, it sold in 2019 and I'm like, wait a second, like you could do 80% like 1 year IO on Fannie
Yeah.
Mae fixed at like 4% and for
Yep.
some reason like you couldn't increase the bid. Like I don't remember why we couldn't increase the bid because the cap rates were probably what, seven? Like let's say on a
Yeah.
B deals
Yeah,
like a
for sure.
seven
B and
cap,
C's,
and then you're
for
like at
sure.
a 4.5 rate or whatever. So you had like 250 basis points of sort of positive leverage going in. And so I guess uh from 2015, I guess, do you remember what changed from 2015 to let's say 18 or 19? Do you remember what started changing? Do you remember? This is like a history lesson for Fannie Mae.
I feel like they got a lot more aggressive on interest only,
Okay, interest
and
only.
obviously
Yeah, that was
rents
like
in
everybody thought that was going to be the beginning of the end. Like, oh my goodness,
yeah.
we went from one
Yeah.
year IO to 3 or 5
It was
years
like
IO.
three. And the other thing too that was completely flipped from where we are today. I mean, back in 2015, 2016, and probably through 2019, everyone was borrowing at 10 and 12-year fixed rate mortgages.
Okay. Yes.
At that point, where now, if you look at, I bet Fannie and Freddie probably did back in 2015 like 2% or 1% of all the mortgages originated were like five-year deals,
Right.
and now that's 40% today. Between 5 and 7 year terms, they're probably 80% of what's actually transacting right now. And then you also have, back then there were no rate buy downs because you're leverage or LTV constrained,
You
not
already,
debt
yeah.
service constrained, and so there really wasn't a benefit. And so in today's world, I would say on shoot probably 75% of the deals that we're working on, there's some sort of rate buy down to lower your rate because you're debt service constrained, not LTV constrained.
So we'll do a very quick flyover. So 2019 happens. 2020, Fannie Mae's really like the only guys lending, right? In 2020 during
Yeah.
COVID. And so
Yep.
rates go to the floor, everything goes to like 3%. fixed. And so, do you remember 2020? I mean, you couldn't come out of your house,
Oh
but
yeah.
do you remember
Yeah,
what?
I do. I remember April through 2020 through probably June of 2020. I feel like all we did were on conference calls talking about like the COVID escrows.
Yeah,
You
yeah,
know,
yeah.
back when there was like you had escrow if you were going to lend, they
Like
had to do
six
12 months
months, 12
P&I.
months. Yeah,
Yeah, so I feel like that's was what we did for 2 months, and then all of a sudden, like it just became like it just exploded. Like I feel like there was like no transaction, really transaction being done April through call it June or July, and then I feel like from like July through the end of the year, it just exploded, and that
yeah,
kind of what kicked off that whole COVID boom, probably through call it for sure the end of 21 and the beginning of 22, and then we've had a little bit of the hangover the last 18 months from kind of the highs of the 2020 and 2021 run.
so 21 and 22, talk about like what Fannie Mae was doing, like in terms of, I don't know if you have a volume number or just like,
Yeah,
I
yeah, sure.
mean, we looked at a lot of deals in 21 and 22 because like
Mhm.
literally there was like 50 deals on the market in Dallas at any one time
Yeah,
for
I
all of
know. Yeah.
21. So, so I mean, talk about how Fannie was sizing and sort of where that was.
Yeah, so in 21 and 22, the agencies actually weren't, they still did plenty of volume just because there was so much activity. So call it, Fannie and Freddie probably each did 70 billion each,
Okay.
which is kind of right around their cap for those 2 years, for sure in 21. But if you go back at that time, that's when the bridge lending got really aggressive. And so on most acquisitions, we were sizing Fannie Mae loans, Freddie loans at a 125 debt service coverage, and you were at like 50% leverage.
Right.
Or you could go get a bridge loan at 75 a cost. And so, I think most of the stuff that was being done was just, term refinances of just like, a lot of legacy owners that, just wanted to take advantage of 2% rates. I remember I locked a deal actually in the Twin Cities, at like 2.7% for 12 years fixed with like 5 years of IO.
Right.
And it's like, you would never, refinance that. So some people took advantage of that, but I feel like at least on the acquisition side, I bet if you talked about those 50 active deals at that point in the DFW market, I bet probably, I don't know, 45 of them probably went some sort of bridge.
Yeah. Yeah,
Um,
for sure.
and the five was probably agency.
Yeah. The five agency because it was like a 1031 and the guy had too much equity he had to put down. So he had 60, he could take
Yeah.
50% or 55% leverage. Um, yeah, because I think this is a mental reminder that if rates are ever, I would say even below 4, you just fix it and just move on with your
You just
life.
forget about it.
Yeah,
Yeah.
forget about it. But we're not that far. I mean, 23, I think was challenging for a lot of people, especially if they were on
Yeah.
floaters. 24, I felt like has been a continuation of 23. It
Yeah.
hasn't, the rates we had in the middle of 23, we did have rates come down. And now
Mhm.
we're sort of back. Now this summer, like towards the end of the summer, we're pretty much back. I mean, you're probably five
Yeah.
to five and a half on Fannie Mae today. And
Yeah.
that doesn't feel too far off back to where we were in 17, 18, 19, like
I was
doing
just
all
gonna
these
say, yeah.
deals. Yeah. So we were fixing deals at 4.5 to 5, 525 back then. I know 525 back then was like people thought we were crazy, but
Yeah.
the majority of people have been doing 5 and 7 year fixed rate stuff with Fannie.
Yep.
Um, does that have they increased spreads on that type of stuff, or has it just been
No,
not really? Okay.
I would, yeah, I would say on the 5 year paper, once you get above 65%, they'll gap out the 5 year pricing because from a credit perspective, these are balloon mortgages. So the shorter you go in term, obviously the more risk there is because you have to refinance it at the end of the term or sell it, or pay
Right.
it off at the end of the term. And so there's a little bit of a gap if you go over 65%. Um, but 7 year paper seems to be a pretty good sweet spot right now where you have a little bit more term. You still get, spreads are still really tight. One thing I was going to add from going back from like 2018 is spreads are a lot tighter.
Mm,
I think there just hasn't been a lot of there hasn't been a lot of transactions, and so the buyers of these mortgage-backed securities, they're just not when there is a live deal. There's a lot of appetite just because there's not a lot of deals being traded, and there's still a lot of capital out there that wants to buy those securities. And so that's something that we've seen. That's I'm just been a little bit surprised that spreads have stayed as tight as they have, even with the more recent rundown in treasury. So I was just talking to a client a little bit earlier today, and that's something we talked about. Like, if the Fed cuts here in the next couple months, you may see the short end of the curve, come
Go
down.
down. Yeah.
But the long end may not come down. And so even if you do get a 10 to 20, 30 basis point pull down in treasuries, let's call the 10-year, you may only pick up half that in actual borrowing costs. Cause I think at some point you're going to start to see some spread widening, if treasuries continue to go down.
Just to compensate for the risk potentially if the economy
Correct.
goes through a soft patch here. Yeah, cards are gonna their spreads are gonna increase. And then I guess you've gone through. I mean, Fannie really like we talked to some lenders and, right now they're like, look, we're not originating anything right now because we're worried about our existing book. Like we're trying to
Yeah.
keep our balance sheet, move some of this stuff off. We've seen some bridge lenders sell some of their loans. Uh, I mean, talk about what you've learned because you get, as an originator, some guys are like, all right, once I originate it, I just send it to asset management and they sort of figure it
Mhm.
out. But in your role, you're a little bit more proactive and you try to stay in front
Yep.
on the asset management side. Is there anything that you've seen or learned sort of through that process? Because Fannie usually does a pretty good job on debt service coverage and all that type of stuff up front.
Yep.
But now yeah, talk about asset management because
Sure.
and maybe some lessons learned because I think from
Yeah.
2015 to 2021, like nobody learned any lessons. Everybody made a lot of money,
Yeah.
but there wasn't as
Yeah.
many lessons learned.
Yeah.
But now the last 2 years, I think there's some lessons learned. So
For sure. Yeah, no, I work really closely with our asset management team and making sure that, we try to be proactive and be a partner with our borrowers, making sure there's an open line of communication. I think if there's one thing that we've learned over the last 2 or 3 years, you can't over communicate, frankly. And so making sure that you are have constant contact with your contact, whether your asset management contact or myself can get looped in. I would say in general too, I mean, agencies, they have their fair share of problems, but not as much as the bridge space does currently. I'd say that if there's really any major issues right now that I've learned probably in the last 2 or 3 years, is just property condition. And so making sure some of those older deals, I mean, if the properties are starting to struggle, some borrowers just are not, putting the appropriate amount of money back into the property.
right.
Right. If your coverages are struggling, I think that we've had some customers and clients that just haven't done the right thing and invested money back in the property. And so you're seeing, Fannie doing a lot of drive-bys of just their existing portfolio, especially in DFW, because the Fannie offices are based in Dallas, and so it's easy for them to kind of scoot around town. And so, just making sure that in lean years you're still doing the right thing and investing in the collateral, because at the end of the day, I mean, from our perspective as the lender, all we have is the property. These are non-recourse loans for the most part, otherwise, rather than, bad boy carve outs. And so you got to make sure that the collateral is actually, is being held up and doing the right things to support the property for the long term.
Yeah, I mean, just from what I've seen, I mean, just holding some additional reserves, not necessarily distributing, every last penny, because whether
Hmm.
it's insurance claims, whether it's, immediate repairs, because inspections or lender inspections or insurance inspections, there's always something going on at these
Yeah.
properties. And then, I mean, a lot of people, if they missed that window, let's say they bought in 19 or 20 and then they didn't sell right away in 21 or
Yep.
22, like they're probably holding these assets longer, right? So you
Hmm.
originally had like a 5-year plan, you put some money up front into the deal, and now it's like 5 years later, like you need to sort of recapitalize these deals and put more money into
Yeah.
them. So
They need them. I mean, those older assets. I mean, you're in the 60s, 70s, 80s vintage deals. I mean, they just need more money put into them. I mean, it's just the reality. I mean, you may have your initial capex budget, which most people do, and it's sizable. But some of the stuff it just accumulates over. When you get to year 5, 6, 7 on a 10 or 12-year term, there's just stuff that needs to get done. I mean, and so you just got to make sure you escrow appropriately. And we obviously take a look at that when we do the property condition assessment over the life of the loan. You have replacement reserves and things like that. But I was talking to a client of mine who they manage, I don't know, 10,000 units, and they like to say whatever the PCA says you should set aside for reserves, just double it.
Double
because
that number.
that's really what it probably, in
The real.
reality, that's kind of what they like to do. And I think it's a good rule of thumb.
The so you guys do Fannie, and then we've also done a number of HUD transactions for you guys or with you guys. So talk about what you've seen. I don't know if you have a a stat on this, but just sort of what on, everybody thinks like in 2025 there's going to be no starts or no
Yeah.
new construction. So like, is the 221D4, is anyone doing 221D4s, or is like everyone doing
Y-
refis at
y-
223F?
Yeah,
Like,
it's surprising. I was just looking
yeah,
at our HUD pipeline, and I would say 80 to 80%, maybe 70% of it was all D4, so
D4s.
construction
Okay.
loans.
All right.
And then the rest was kind of refinances. I feel like from the refinance program, the 223F program with HUD, you know, it's just not as, I think the agencies are a little more competitive at the moment on the refinance space, but the construction side of things is really busy because, banks are really struggling to lend. Obviously, life insurance companies will touch new construction, but a lot lower leverages. And so with the HUD 221D4 program, it's a very programmatic. It's kind of counter cyclical. And so the program sets a 40-year amortization, or to call it a just under 118 debt service coverage, 35 or 40-year amortization. Like I said, it's non-recourse. And so kind of in all cycles, the goal of the HUD program is really to provide liquidity for multifamily in all cycles. And so it's actually a great time, I feel like, to, if you can figure it out, to build, because by the time you're coming out of the ground,
There's nothing
rents
delivering. Yeah.
should, there's nothing delivering, and you should see a pop in, in rents. And I think it's the multifamily market's going to be a lot more healthy when you come out of the ground. During if we end up going to recession, it's great to be building during the recession and open when you get on the other
Hopefully it's
side of it.
cheaper, right? Hopefully the costs are lower
Yeah,
while you're building, and
that's right.
then you come out
That's
the
right.
backside and like the economy's doing better again and rates have dropped,
Yeah.
then yeah, you can refi, or you don't need a refi, I guess, on the HUD. You're
Yeah,
already set.
it's
Yeah.
construction and perm, man. So you're
Yeah.
fixed, and so that's another benefit. Like I think people didn't really realize how beneficial that was through the last cycle.
Yeah.
Where like you don't need to worry about the takeout. You're
Right.
seeing people that built in 20, they started building in 2020 and opened in 23, and you open at a completely different capital market. So even if you were pretty reasonable in your leverage on your construction loan, you're most likely having to do some sort of cash in on the way out, and that's tough to model. So I think having that fixed rate that up front takes a lot of risk off the table. The one thing I'll bring up with the HUD product as well, it just takes a little bit longer than obviously a conventional loan. And so, I like to say it's 9 to 12 months from start to finish, as long as you get us involved on the front end, like when you're starting to, look at sites and things like that, it really ultimately doesn't add too much time. I'd say like from when you have a 90% uh, of a 90% set of plans and specs, we can probably close within 90 to 120 days. And so as long as you kind of piece that in, and we can work with your clients on that, to making sure if you are looking at a site, put together a proper timeline so it doesn't really add too much extra time to close on the HUD loan.
What's that what experience does HUD want? Sort of, obviously it's a different, Fannie would want, previous multifamily experience, net worth liquidity, of the loan amount, 10% of the for liquidity. But
Yep.
then on the HUD side, I mean, I'm assuming, these are 200 unit deals, 200, 250 a door to build it. So you're looking at
Yep.
like 40, $50 million loans.
Mhm.
Do they want the same requirements like that
I
Fannie
think
wants, or is it
it's not as hard and fast as I would say Fannie.
okay?
I mean, we like to say, just to be safe, you can say 10% liquidity post closing and 100% net worth, I think is a good parameter.
Okay.
But I don't think it's not a hard and fast rule. They're really looking at experience.
Okay.
And so, we've closed HUD new construction loans where, the developer may not, have developed before, but they build a team around them
Okay.
that has really done it. So, strong general contractor that has that experience, a strong management company that has HUD experience, architect who has HUD experience. So you kind of build a team around that. I would say that you should probably at least own a like sized
Property.
property.
Okay.
Maybe it's your first development deal, but you can say, hey, we own and operate a deal of a similar size. So that's, you know, ultimately HUD understands that you have to do your first HUD deal before you can do your second, right? So like
Yeah.
to have a repeat, everyone has to start somewhere.
But
And so
they'd
it's just
rather
making sure that you
they'd
build the
rather
right
you
team.
Yeah, they'd rather you learn like on someone else's loan first, like go do a couple bank
100%.
loans
Yeah.
first on smaller deals, maybe 50 units,
Yeah.
100 units before you like come out of the ground with 300 units in Frisco. Like that's probably not like your first deal
Yeah. Yeah.
to do. So I guess anything else on the Fannie or HUD side that we haven't covered that I mean, I was gonna bring this up, but I guess enhanced due diligence, anything on that
Yeah.
borrowers should be
I would just
aware
say
of
there's,
that, like, yeah, that I mean, there was an article about it, but I mean, we feel it sort of day in and day out. But anything from the borrower side that they should know,
I think
um,
there's probably more stuff that'll come out, but essentially they're just making the lenders verify more information.
yeah,
Um, making sure that we have a video call with the sponsor so we know that they're a real person. We visually see them, right? Make sure you check that box.
yeah,
Yeah, they're especially for newer investors.
right,
There's just enhanced due diligence that we have to get. So it's not necessarily like super cumbersome.
yeah,
It's just making sure that we're checking all the right boxes. And I think there's obviously through this last cycle there was some fraud involved across different groups, and so I think it's just making sure that um, you know they're catching the fraud on the front end, or just doing what we can do on our end, and making sure that we don't we're not susceptible for doing something that we you know is unethical or illegal.
right. Okay. All right. Well, I appreciate you jumping on and just give us an update on what you're seeing out there right now. And then you'll be at the conference, the Old Capital Conference in October. And so we appreciate you guys sponsoring that event. You guys were the very first sponsor from the very first conference.
Yeah,
So
8 years. It's crazy,
I,
James.
I
It's
don't
wild.
know.
If time flies.
I don't know if we would have even started it from the beginning. So we appreciate you
You bet.
sponsoring the first one, having no track record. So
Yeah, it's a great. No, I honestly, it's a great conference.
yeah,
I think the networking, is pretty incredible. It's a great mixture of folks, whether it's lenders, investment sales brokers, management companies, other, third party servicers. I just think it's a really great conference that I recommend anyone of all levels of multifamily, whether you're looking to buy your first deal or you own 20 deals. I think there's a lot of value. It's not just people sitting up on a panel that you know you're not really learning a lot. I think it's really pertinent to what's actually going on the day-to-day, deal by deal side of things. So I think it's a great conference, and love that we're a part of it.
yeah, no, we appreciate it. And every time I go to a conference, I like expect the same as our conference, but I'm always like, where's this person? This person, this like
Yeah.
it's just different. So we
And,
appreciate
and
it.
I
Yeah.
also said, and it's funny. You're always
Yeah.
going to get a good laugh too. The content is very entertaining as well. It's not
Well,
stale for sure.
we'll definitely try to add some sort of spin this year. And so we appreciate you coming on, and we'll see you at the conference in October.
Sounds good. Thanks,
All right.
James.
See ya. All right, bye.